Welcome everyone to another crucial edition of Updates with John. Today, we're diving deep into a story that's unfolding with unprecedented intensity in the global silver market. A narrative that the conventional paper futures price simply isn't reflecting. Imagine this. In the first 4 trading days of December 2025 alone, a staggering 60% of the COMEX registered silver inventory was claimed for physical delivery. That's an astonishing 47.6 million ounces vanishing from the vaults in less than a single week. And here's a detail that should make you pause. The institution responsible for issuing 99% of those delivery notices in a single day in January 2026 was none other than J.P. Morgan. December 2025 then went on to record an astounding 65 million ounces in total COMEX physical deliveries, a single-month record in the entire history of the exchange. January 2026 followed suit with 49.4 million ounces, a figure 7 times greater than what January 2024 had generated. Looking at the full year, 2025 saw a combined 474 million ounces of physical silver settled, compared to 203 million the year prior. This means the rate at which real, tangible silver was being removed from COMEX vaults more than doubled in a single calendar year. And right now, as we speak, the Shanghai premium is sitting at a remarkable 18.1% above the Western spot price. Something profound is happening in the global silver market, a reality that the paper futures price on your screen is failing to capture. By the end of this discussion, you will understand precisely what this phenomenon is, why the COMEX, due to its inherent structure, cannot halt it, and why Shanghai is no longer just a regional pricing anomaly, but a fundamental shift in how silver's value is determined across the entire world. But here's the critical insight that almost no one is talking about. COMEX and Shanghai are not merely competing in the same market anymore. They have in essence evolved into 2 entirely distinct markets, catering to 2 fundamentally different grades of silver. And this separation, this crucial distinction, represents the most significant structural story in silver today, one that almost no retail investor in America truly comprehends. Stay with us, because grasping this distinction changes everything about how you should interpret the silver price you see quoted today. Let's begin by dissecting what is actually transpiring within the COMEX, because the physical delivery numbers we're witnessing are unlike anything this exchange has ever processed in its long history. For 15 consecutive months leading up to early 2026, physical silver has been systematically exiting COMEX warehouses at volumes the exchange was simply not designed to handle. According to meticulous research published by Real Clear Markets in March 2026, December 2025 alone accounted for an astonishing 65 million ounces of physical deliveries. This figure stands as an unprecedented single-month record. January 2026 continued this trend, generating 49.4 million ounces, a staggering 7 times the volume recorded in January 2024. And for the entirety of 2025, a colossal 474 million ounces of physical silver were settled, compared to 203 million in 2024. These numbers unequivocally demonstrate that within a single calendar year, the rate at which real, tangible silver was being removed from COMEX vaults more than doubled, all without a single headline event that most people could readily identify. What unfolded next sent shockwaves through the investment community. In the first 4 trading days of December 2025, over 60% of the COMEX registered silver inventory was claimed for delivery in less than a week. That's an astounding 47.6 million ounces withdrawn in just 4 trading sessions. Subsequently, on February 11th, 2026, COMEX registered silver dipped below the 100 million ounce threshold for the very first time. The exchange reported a single-day negative adjustment of 3.256 million ounces in the registered category, while vaults simultaneously reported withdrawals exceeding 4.7 million ounces from eligible silver in the same 24-hour period. Now let's examine the current live situation as of this week, drawing from official COMEX data provided by goldsilver.ai. The July 2026 first notice day is just 6 business days away. There are still 39,356 open contracts, representing a massive 196.8 million ounces of silver in the July delivery month. Against this backdrop, COMEX registered silver currently stands at approximately 82 million ounces. This translates to a coverage ratio of a mere 16%. It's important to note that a ratio below 15% is explicitly defined by COMEX's own methodology as stress territory. We are therefore just one standard deviation away from the exchange's own official definition of a stressed market. And that 16% coverage against 196.8 million ounces of open July contracts is the kind of arithmetic that makes every professional silver trader watching this right now feel a profound sense of unease. But here's the crucial piece of information that Wall Street, for its own reasons, would prefer you not to know. The paper silver price that flickers across your screen right now may not be accurately reflecting what silver is genuinely worth in the physical world. This is because COMEX and Shanghai are now operating as two fundamentally distinct markets. This separation isn't merely due to geographical distance or currency differences. It's primarily driven by a critical distinction in purity. The standard silver traded on COMEX is 99.9% pure. In stark contrast, the silver traded on the Shanghai Futures Exchange is 99.99% pure. That seemingly small extra decimal point creates what one senior analyst at TraderFerg's Substack accurately described as two distinct markets rather than a single, continuous, and interchangeable market. And crucially, these two markets cannot freely substitute for each other. TraderFerg's December 2025 analysis, which has proven remarkably accurate in the month since, explicitly stated that Chinese industrial demand is actively pulling physical silver from London and COMEX vaults into SHFE delivery. The SHFE is experiencing severe backwardation, a market condition where the spot price is higher than the futures price, indicating strong immediate demand, yet the COMEX paper markets continue to operate nominally, seemingly unaffected. However, behind the scenes, a very different story is unfolding. The practical consequence of this purity differential is profound. Chinese solar panel manufacturers, electric vehicle battery assemblers, and semiconductor fabrication plants all require 99.99% pure silver. They simply cannot utilize 99.9% COMEX grade silver in their highest specification industrial processes. Consequently, they are compelled to purchase in Shanghai, paying whatever premium is necessary to acquire the correct grade of metal. And that premium today, according to FindBullionPrices.com, which meticulously tracks the Shanghai Gold Exchange benchmark daily, stands at a remarkable 18.1% above the Western spot price. The most recent data point shows the SGEAM fixing trading at an 18.1% premium and the PM fixing at 16.8% above the equivalent US dollar COMEX price. Now prepare for a number that will likely surprise you. When you factor in China's 13% value-added tax on imported silver, in addition to the Shanghai premium, the true landed cost of silver for a Chinese industrial buyer utilizing international supply is not just 18% above COMEX. It is, in fact, closer to 35% to 40% above the COMEX quoted price for silver that actually arrives at their factory, ready for immediate use. That, my friends, is the real price of silver in the world's largest industrial silver market. And the price quoted on COMEX, $63 to $66 today, is simply not that price. It is the price of a paper contract in New York. That significant gap, that profound divergence, is the single most important signal in the silver market right now. The real story, however, is even larger because this premium structure is not a recent phenomenon. It has been steadily building for the majority of 2025 and 2026, and its historical trajectory provides a clear indication of what it predicts for the future. In December 2025, when the Shanghai Gold Exchange AGT plus D spot contract was settling at $78.55 per ounce versus COMEX at $72.36 per ounce, analysts at Silver Trade explicitly noted that the situation reflected strong near-term physical demand in China, significantly outpacing the willingness of sellers to supply at COMEX-aligned prices. They highlighted that this inversion was driven by industrial sectors, particularly solar panels and electronics, aggressively bidding to secure metal amidst import restrictions and vault outflows. And what transpired after that December premium spike? Silver surged to its all-time high of $121.62 per ounce on January 29, 2026, within a mere 5 weeks. The premium, in this context, served as a leading indicator, not a lagging one. Now here's the critical question that every American investor watching this needs to honestly answer for themselves. If the Shanghai premium was hovering around $8 per ounce, representing a 10% to 12% premium in December 2025, and that phenomenon subsequently led to silver reaching an unprecedented $121 in January 2026, what then does an 18% premium in June 2026 signify, especially when silver is currently trading at a seemingly suppressed $63 to $66? Most silver investors unfortunately miss this crucial signal because their focus remains fixated on the COMEX paper price, which they mistakenly equate with the actual price of silver. However, the real physical price for the specific grade of silver that Chinese factories genuinely require is currently 35% to 40% higher than that COMEX number. And this fundamental disparity changes everything about how one should interpret the current $63 COMEX quote. Let's now shift our focus to why the COMEX, due to its inherent structural limitations, is fundamentally incapable of stopping what is currently unfolding. This goes far beyond mere inventory numbers. Consider the Sprott Physical Silver Trust, one of the largest allocated silver funds globally. In January 2026, it doubled its capital raise program to an impressive $2 billion. At the prevailing silver prices that month, this represented the capacity to purchase approximately 18 million ounces of physical silver, roughly 16% of the entire COMEX registered inventory, in a single institutional move. Sprott, it's important to understand, is not in the business of manufacturing solar panels. Their objective is to remove physical silver from the readily tradable pool and place it into allocated storage. That silver, once acquired by Sprott, is effectively gone from COMEX's accessible inventory. And they are not the only institution engaging in this behavior. Large financial institutions are increasingly demanding physical delivery to satisfy internal compliance requirements and to fulfill portfolio diversification mandates. Corporate treasury departments are now viewing physical silver not merely as a speculative asset, but as a crucial component of supply chain security. And cross-border flows consistently direct silver from COMEX towards Shanghai, precisely because the persistent premium in Shanghai creates a highly profitable arbitrage opportunity for any entity capable of executing international vault-to-vault transfers. Each of these withdrawal motivations operates independently. Yet, each one generates a permanent and relentless drain pressure on COMEX registered inventory. And that, my friends, is where the situation becomes truly precarious. Because COMEX has historically relied on one core assumption to operate at its current scale, that the vast majority of futures contract holders will never actually ask for physical delivery. They will instead roll their contracts forward, opt for cash settlement, or simply exit their positions without ever needing to touch a real bar of silver. For decades, this assumption held firm. However, in 2025, that assumption began to fundamentally break down. The settlement of 474 million ounces of physical delivery in a single year, against a registered inventory that today sits at a mere 82 million ounces, is the clearest possible evidence that the roll and never deliver assumption is under severe and escalating pressure. The COMEX certainly possesses tools to defend itself, and it has already deployed some of them. The CME Group dramatically increased margin requirements after silver surged past $100 in January 2026. This margin hike forced leveraged long position holders to either sell their positions or put up significantly more cash, thereby generating the cascade of selling that contributed to silver's sharp decline from $121 to $63. And as one analyst at investing.com pointed out, the exchange also has Silver Rule 7, the emergency procedure famously introduced in 1980 when the Hunt brothers attempted to corner the silver market. This rule allows COMEX to convert into a liquidation-only market, effectively refusing new long positions under extreme circumstances. It's important to clarify that COMEX will not formally default. The robust institutional and regulatory structure surrounding it is designed to prevent a clean, outright default. However, what COMEX is demonstrably unable to stop, despite all its available tools, is the steady, systematic drain of physical metal from its vaults. This drain is driven by a powerful confluence of industrial demand, strategic investment allocation mandates, and profitable cross-border arbitrage flows directed towards Shanghai's higher premium market. And with each million ounces that permanently leaves COMEX vaults, The physical buffer between the exchange's paper claims and the real metal available to back them is irrevocably reduced. Now let's directly connect Shanghai to the near-term price outlook, because the 18.1% premium isn't just an interesting data point. It is, in fact, an actionable signal. When analysts at Silver Trade defined what a meaningful premium indicates, they specifically wrote that an $8+ premium signals robust buying interest for deliverable physical silver in Asia, significantly outpacing the willingness of sellers to supply at COMEX-aligned prices. This divergence, they noted, frequently emerges during periods of physical tightness, where importers and industrial users in China aggressively bid to secure metal amidst import restrictions, vault outflows, or surging domestic demand. Right now, all three of those conditions are simultaneously present. China's January 2026 export control framework restricts 60% to 70% of global refined silver supply to only 44 licensed companies that meet minimum production thresholds of 80 tons annually and possess $30 million credit lines. Concurrently, Chinese SHFE and SGE warehouse inventories have been declining, and the 18.1% premium being paid today is a direct reflection of that potent combination: export restrictions tightening domestic Chinese supply, falling SHFE inventory, and industrial buyers continuing to bid for metal despite the hawkish stance of the Federal Reserve and the COMEX paper price hovering around $63. Here's the most crucial fact about the 18.1% premium, a detail that professional traders meticulously track but retail investors almost universally overlook. The Shanghai premium is a directional indicator, not merely a static price level. An 18.1% premium that is heading higher is a clear signal of accelerating Chinese physical demand. Conversely, an 18.1% premium that is heading lower would signal an easing of Chinese demand. And currently, this premium has been steadily recovering from the temporary collapse that occurred after the FOMC's hawkish shock in mid-June. That partial recovery in the premium, occurring while COMEX paper silver remains near its recent lows of $63 to $66, tells you unequivocally that the physical market in Shanghai is stabilizing and buyers are re-engaging, even at current price levels. If the Shanghai premium continues its recovery, pushing towards 25% or even higher, while COMEX paper prices remain suppressed, that widening divergence between physical market reality and paper market pricing creates the exact environment where a rapid repricing event becomes not just possible, but highly probable. This is because arbitrageurs and contract holders standing for delivery at COMEX will eventually recognize that the metal they could withdraw from COMEX at $63 is in fact worth 18% to 25% more the moment it arrives in Shanghai, and that arbitrage window will remain open until either COMEX paper prices rise significantly to close the gap or Shanghai prices fall to close the gap. Given that Chinese industrial demand is structural, growing, and is further bolstered by China's export control framework, which restricts its own silver from leaving the country, the more likely resolution is COMEX prices rising towards the physical reality that Shanghai is already pricing in. Major financial institutions are already forecasting this. Commerzbank, for instance, maintains a $90 year-end silver target. JP Morgan's models project $85 in Q4 2026. The Reuters analyst consensus stands at $79.50. All of these institutional targets are already embedded within a framework that assumes the physical market will eventually compel the paper market to reflect reality. The 18.1% Shanghai premium, the 82 million ounce COMEX registered inventory, the 196.8 million ounces of July open interest with just 6 business days until first notice day, the 474 million ounces of physical COMEX deliveries in all of 2025, and the Sprott $2 billion capital raise, all these data points reside within that same overarching framework. They are not isolated pieces of information. They are different facets of the same compelling story told through various measurement instruments, and every single one of them is pointing in the same undeniable direction. The paper market in New York is currently pricing silver at $63. The physical market in Shanghai, however, is paying 18.1% more than that for real tangible metal right now. The historical precedent for this specific divergence strongly suggests that the gap will close upwards, not downwards. If you have any questions about what we've covered today, please drop them in the comments section below, and we will endeavor to address every single one. If this video provided you with information you didn't have before, please take a moment to like it and share it with someone who needs to see this right now. And if you haven't yet, make sure to subscribe to AG, John OG Official, so you never miss another video like this one. We will see you in the next one. Let's delve deeper into the profound implications of this divergence between the COMEX paper market and the Shanghai physical market. This isn't just an academic exercise. It has tangible consequences for every participant in the silver ecosystem, from industrial consumers to individual investors. The existence of a persistent significant premium in Shanghai for physical silver, coupled with the relentless drain on COMEX inventories, paints a picture of a market under immense stress. This stress is not merely a short-term blip. It is indicative of deep-seated structural issues that are fundamentally reshaping the global silver landscape. The traditional understanding of silver as a fungible commodity, easily transferable and uniformly priced across global exchanges, is being challenged. The purity differential, 99.9% versus 99.99%, might seem minor to the uninitiated, but for high-tech industrial applications, it is a deal-breaker. This means that a significant portion of global industrial demand simply cannot be met by the COMEX standard silver, forcing buyers to seek out the higher purity metal, predominantly from Shanghai, at whatever price is necessary. This creates a bifurcated market where the price signals from COMEX become increasingly detached from the physical reality of industrial consumption. The paper price, influenced by macroeconomic factors, speculative trading, and regulatory interventions, may fluctuate, but the underlying physical demand, particularly from China, remains robust and unwavering. This disconnect is a powerful indicator of an impending repricing event. History has shown us that when such a significant gap opens between the paper and physical markets, the physical market eventually asserts its dominance, forcing the paper market to adjust. The question is not if, but when and how violently this adjustment will occur. Consider the various players in this intricate game. On one side, you have the industrial giants in China, driving innovation in solar, EVs, and electronics, all of which are ravenous consumers of high-purity silver. Their demand is not discretionary. It is foundational to their economic growth and strategic objectives. They are willing to pay a premium because the cost of not having the silver far outweighs the additional expense. On the other side, you have the Western financial markets, where silver is often treated as a financial asset, a hedge against inflation, or a speculative play. The COMEX, with its vast paper contracts, has historically provided liquidity and price discovery. However, its reliance on the assumption that physical delivery will rarely be demanded is now being severely tested. The steady stream of physical withdrawals, driven by both industrial demand and institutional allocation, is eroding the very foundation of this paper market. This erosion is not a sudden collapse, but a gradual, relentless process like water eroding a rock. Each ounce that leaves the COMEX vaults reduces the buffer, making the system more vulnerable to a sudden surge in physical demand. The implications for market stability are profound. A sudden, widespread demand for physical delivery could trigger a crisis, as the available registered inventory is simply insufficient to meet all outstanding paper claims. While the exchange has mechanisms to prevent a formal default, such as forcing cash settlement or implementing emergency rules, these actions would undoubtedly lead to extreme price volatility and a loss of confidence in the integrity of the market. Furthermore, the structural limitations of silver supply cannot be overstated. Unlike other commodities where a price surge can quickly incentivize increased production, silver supply is largely inelastic. As we've discussed, the majority of silver is a byproduct of other mining operations. This means that even if silver prices skyrocket, miners of copper, lead, zinc, and gold will only increase silver output if it makes economic sense for their primary metal. This inherent dependency means that the silver market cannot respond quickly to its own demand signals. Building new primary silver mines is a multi-year, capital-intensive endeavor, fraught with regulatory hurdles and environmental concerns. The lead time from discovery to production can be a decade or more. This lack of short-term supply elasticity exacerbates the current deficit, making it a persistent and growing problem. Recycling, while a potential source of supply, also faces significant challenges, particularly with the silver used in modern electronics and solar panels. The silver content per unit is often very low, and the recovery processes are complex and costly. Moreover, products like solar panels have long lifespans, meaning the silver contained within them will not be available for recycling for decades. This effectively removes a substantial portion of industrially consumed silver from the circulating supply, creating a one-way flow from mine to product with limited return. This structural deficit, coupled with the insatiable demand from China and the dwindling inventories in Western vaults, creates a perfect storm for a significant repricing of silver. The current market price, therefore, appears to be fundamentally undervalued when viewed through the lens of physical supply and demand dynamics. The Shanghai premium is not just a reflection of current demand, it is a forward-looking indicator, signaling where the true value of silver lies. Professional traders and institutions understand this implicitly. They are not just looking at the COMEX price, they are analyzing the premium, the lease rates, the inventory levels, and the geopolitical shifts that are driving the physical metal. The fact that major financial institutions are forecasting significantly higher silver prices by year-end, despite the current suppression, underscores this understanding. They recognize that the paper market cannot indefinitely ignore the physical reality. The arbitrage opportunity created by the Shanghai premium is too compelling to ignore. As long as there is a substantial profit to be made by moving silver from Western vaults to Eastern factories, that flow will continue, further depleting COMEX inventories and increasing the pressure for a repricing. This is not a conspiracy, it is basic economics playing out on a global scale. The market is seeking equilibrium, and that equilibrium will likely involve a significantly higher price for silver. The question for investors is whether they are positioned to benefit from this inevitable adjustment, or if they will be caught off guard by the sudden shift. Here at Updates with John, we aim to provide you with the insights to make informed decisions, to understand the underlying currents that drive these markets, and to prepare for the changes that are already in motion. The story of silver is a testament to the power of physical reality over paper promises, and it's a story that will continue to unfold with dramatic implications for the global financial system. Stay tuned, because the most interesting chapters are yet to be written. We will continue to monitor these developments closely and bring you the latest insights as they unfold. Until next time, stay vigilant, stay informed, and keep asking the right questions.